Okay, we'll start the lecture. Good afternoon to all of you. The first lecture we just introduce the pricing. There we discuss factors affecting or the factors which really influence pricing decision. There were external and internal factors. Among them, cost information is vital, and in this chapter we are putting more effort on cost information. Then we discuss the economics model for pricing, where MR is equal MC point. So at that point we assume we think that is the maximum profit, maximizing profit. But to adopt this MRMC concept, economics theory, we have a lot of weaknesses. Weaknesses we discuss under 4 headings. Very difficult to, you have to forecast the demand and cost function information. Demand is not only influenced by prices, by other factors like prices of commodity, substitutes, income, preferences. I think you can remember the assumptions you follow when learning the demand theory. So that weakness is there. Then profit max, when you try to maximize the profit, firm may pursue other goals like social, welfare, employee salaries, social responsibility, environmental accountability, etc. Then we discuss the pricing from 2 perspectives, price takers perspective and the price setters perspective. When you look at the price takers and price setters perspective, the cost information we divided into 4 parts. Based on the cost informations, if you are a price setter, you may take short-term decision, you may take long-run decision, price. But if you are a price taker, you are not making any pricing decisions. Most probably you will make product mix decisions. So thereby mix decisions we will be discussed under 2 type, short-run mix decision and the long-run product mix decisions. So what we did was, then we discussed the price setting firm facing short-run decision. There we, of course, we talk about the, relevant cost. Always we talk about the relevant cost. And you can, I think if you, you can remember, we were able to identify relevant variable cost, then incremental fixed cost. In this example, certain costs given, even though it's given in terms of unit cost, we didn't consider those costs are relevant. Example, fixed cost, what is already incurred, or the remaining fixed cost, we didn't consider whether it's in unit form or whether it is in, rupee wise. But additional fixed cost we consider. So I think you can remember this example answer for the question. 14 rupees and 15 rupees was not relevant because it's the unit manufacturing fixed cost and unit distribution fixed cost. So thereby we marketing and distribution cost, so thereby we didn't consider it. And also the fixed manufacturing overhead not relevant. 165, which was relevant, we consider. So thereby we took all relevant cost and we will end up with the minimum price as 52.10 cents. Okay, so how do we arrived at this? I explain it. Then when there is an opportunity cost there, when taking short-run pricing, so you need to consider the opportunity cost as well. In this example, unit contribution per unit. Unit contribution will be considered the opportunity cost. You can remember the selling price is 100 minus 38 and 13, which are relevant variable cost, and multiplied just to get the total. So thereby you will end up with this figure, and the opportunity cost, when there is opportunity cost, your price, minimum price has to be 101 cents. This is the minimum price. Minimum price means which is equal to the relevant cost of the particular order. Relevant cost of the particular order. So we'll move on to the second part, that is short-run pricing setting. If you are a price setter, long-run pricing can be divided into three parts: pricing customized product services, pricing non-customized product services, and target costing for pricing non-customized product services. So these are the three scenarios what we are going to discuss under the price setting firms. First one, pricing customized product services. You have to remember, we are discussing price setting perspective, cost information. Cost plus pricing is very simple. Pricing customized product means you are producing a unique product, so there is no substitutes available, and you are a unique producer. Your product is different, your product has already been differentiated from other products. So thereby there is no comparable identical product in the market. You need to set the price. So there are basically three methods. You can adopt variable cost plus pricing. So thereby you have to identify the variable cost, then add a markup. In this example, 150% added. So the price would be 100. Direct cost plus, already you have to identify the direct cost for your product, then add a markup, that is called direct cost plus. And full long run cost means really you can calculate the full cost, including the indirect absorption costing, including allocation cost. So you will end up with, when you add a markup, long run cost. So when you include more and more cost elements, earlier we include on the variable cost. When you include more and more variable cost, what happens? Your markup is getting reduced because you have already considered those cost element only. Here, if you take here, 40% represent only the profit, but 70% represent profit plus the fixed overheads. Here, 150 represent other indirect fixed cost, and profit margin and the production overhead. That's why we need large amount of markup. Anyway, that is the pricing customized product. Then pricing customized product using cost plus pricing, you need the accurate costing. So thereby you can decide a reasonable amount of target markup. So thereby once you calculate this markup, cost plus markup based pricing, you may adjust the price according to the customer expectation. Of course, example, you may say that, okay, unit price is 100. So if you feel that there's a greater amount of demand, customers are ready to pay more than 100 rupees, then you will say, okay, price is not 100, 110, 112. Or if you feel that this is not acceptable, very difficult to play in the market, so thereby you may say that 98 rupees, something like that. So thereby, once you decide the price based on the cost plus pricing in the longer run, what you can do is you can adjust to reflect demand, types of products, industry norms, competition position. That means once you decide the price based on the cost information, other factors may help you to adjust. Other factors means what we discuss in the factors influencing in when deciding price or the pricing matter. So other factors are coming under here. You need, as I told you, accurate costing system and determine the selling price. Full cost should be calculated and markup should be added. That is okay, very clear. Assignment, cost assignment, allocating indirect cost to the product, of course, should be based on cause and effect, especially. Direct cost tracing is very simple. You can do it, but allocation has to be cause and effect assignment. I think you can remember we discussed job costing, cost absorption costing, blanket white rates, departmental overhead rates, ABC systems. So theoretically, people say that ABC system will provide, better understanding for the cost behaviors, activity-based costing, right? That is about cost plus pricing. Then we'll move on to the pricing non-customized product. Non-customized products means you may not producing 1 unit or 2 units. You may produce larger amount of products, but still you are not in the perfect market, and your unknown volumes, very difficult to predict the demands. So may apply large unknown volumes of single product that is sold to thousands of different customers. That is the scenario, non-customized. May apply cost plus pricing. The circular process occurs, selling price, sales volume, and lack of market data making a pricing decision. Here the case ones talk about the lack of market information. The case 2 talks about the market shares and sales volumes available, data available, right? We'll see one by one what is this case. And the Auckland company is launching a new product. Sales volume will be dependent on the selling price and customer acceptance, but because the product differs substantially from the other product within the same product category, it has not been possible to obtain any meaningful estimates of price-demand relationship. So it says that you don't have data about the demand story. At this price so much, at this price so much, you don't have that data. The best estimates is that the demand is likely to range based on the experience, market information, business experience. They assume that Auckland company really assume that the demand would be between 10,000, 100,000 to 200,000 units, provide that selling price is 100 or less than 100. So they say that the price should be always 100 or less than 100, not more than that. That's their assumption. That is their experience. That is their expectation. Based on this information, the company has produced the following cost information and selling price required to generate a target profit of contribution 2 million from the. So you see that, okay, whatever the thing situation, we need 2 million profit or we need 4 million profit. That is the business target or objective. I think you can remember we discussed that in the first slide. Reasons profit objective may influence the pricing. Profit objective may influence the price. So thereby, for this case, it says 2 million profit. That's why here this third line, 2 million profit, whatever the possible scenario, whether it is sales volume so much, whether it is sales volume so much, so whatever the sales volume. Here 100,000, 120,000, because you have to remember all the data in thousands and sales volume. So total cost for the sales volume given based on the calculation, cost available information. And if the total cost is so much, profit has to be added. So thereby this has to be the selling price, 12,000. Required sales volume, 12 million, 12.8 million, 13.2 million, 13.6 million, 14.6 million, 15 million. Then what we do is we forecast this particular data based on the 100,000 volume. So thereby what we do is we divide this 12 million from 100,000. So thereby 120 is the price. Here the selling price is 12.8. Here's a 13 point. Here 85. Here 80.11. Here 15. And the unit cost is so much. So what you can do is what would be the selling price? So you may select the particular selling price based on the convenience. So if you feel that you can sell 100 units at 100,000 units at 120, of course, you will go for this. So thereby it's a kind of, cost approach with a profit margin. So you see that depending on the sales volume, your selling price is, changing. When you sell more and more, what happens is your selling price is reduced. And when you produce more and more also, your cost will reduce. So that is the nature of the large scale production, maybe due to the fixed cost behavior. When producing more and more, your unit fixed cost will get reduced. So that will reflect here also. That is with no information. So you can select whatever the feasible, whatever the convenient sales volume and price for your business for the next 2 months or the next year, because we are talking about the long run product long run pricing, right? When it comes to the case B, it's not like that. Case B is also same data, but the same cost schedule applies, but the 2 million minimum contribution no longer. There is no such profit objective. In addition, Auckland now undertakes market research base, and the research finding has given, research finding says that, okay, you can sell 10,000, 100,000 units, 90,000 units, 8,000 units, 70,000 units, 60,000 units. But estimated sales volume at the potential selling price is, so you see, if the price is 120, you can sell only 100,000 units. If the price is 190, of course, you can sell 70,000. That's something like based on the research data you may find. So then what is the total revenue would be this multiplied by this, selling price 100 rupees multiplied by 120,000. So you get 12,000. 90 rupees multiplied by the 140, you get the sales revenue. Then the total cost is same because we are using the same data in the case B, case A. So you will end up with the profit of so much. You will see that when you reduce, when you reach 60 price to 100,000 units, so you are ending up a loss. So thereby, according to this chart, I think the best suitable price where your profit is maximized would be 80 rupees per unit and 180,000 sales. So that would be the case B approach. But again, still we are using the cost plus approach, but in a different way. Then the case 7.4, I think we discussed this also, but just NCC company manufactures 2 brands of computers: simple computer SC and complex computer. So all the data is given, ordering cost, testing, rework, number of orders placed 17, number of testing hours, number of unit works, and direct material 450 and 66.50 is the direct labor. So thereby you can calculate the cost. Cost is something like this: DM 450, direct labor 60, ordering cost per unit would be, target costing per unit would be, and the rework would be so much. Okay. Then we will move on to the next one, the pricing non-customized products and target costing. Target costing is the reverse of cost plus price. It's a Japanese method. You work out first selling price, then go back to the costing. Earlier, what we did was traditional method, cost plus method is we decide the cost first, then go for the pricing. That means cost plus pricing is internal focus. Cost plus pricing is internal focus, and target costing is external focus. Cost plus pricing is factory oriented, business oriented, organization oriented. Target costing is customer oriented or market oriented. That's the meaning. So you start from the market. What is the price customers are ready to pay? So based on that, you will start the market. So marketing factors and customer research provide the basis for determining selling price, not the cost. Cost is not important when deciding when doing the target costing approach. Emphasize a team approach to achieve the target cost. So you need the teamwork to get the target cost. 4 stages: determine the target price, deduct the target profit margin, estimate the budgeted cost of the estimate the cost exceed target cost, investigate ways of driving down to the actual cost to the target cost. These are the 4 steps, but even though 4 steps are there, this is very simple. We'll take one example. In activity 7.5 NCC, management wants 15 target operating income on the sales revenue of CC. Target sales revenue is 750 per unit. What is the target cost per unit? So we will focus on 7.4 example. I think target cost would be, because 15% operating income, price is 750, so thereby 85% needs to be target cost. So 75 into 85% target cost. Then the current cost we have calculated as per 7.4. Assume the current cost is 592. So thereby what happened is the difference between these two, that is current cost and the target cost, would be the cost reductions. Now what you have to do is we need the teamwork to reduce the existing cost structure per unit by 55.30. That is the logic. So thereby for this, of course, you may use different approaches to reduce, control, manage the cost. For example, you may identify where the unnecessary or the inefficiencies incurred, where the resources are really wastage you may be identified, non-value adding ideas. Maybe you may use the continuous improvement or quality circle or teamwork to really ABC analysis for the cost. Which cost is more? So which cost we need to focus on more? Which cost we need to focus on less? What is material significant cost element? What are less significant important elements of? So likewise, anyway, cost reduction techniques, cost management techniques, strategic management cost technique will be helpful with the teamwork to reduce this particular 55.30 and to reach the target cost of 530.5. And the pricing would be then 750, which is convenient for the customers. And you are in a position to look at your product, not from the factory perspective, not from the cost plus perspective, but from the customer's perspective. What price are they ready to pay for the particular product? So those are the 3 areas of price setting, price taker's position under mix decision. Then pricing short run product mix. We will come to the now we took the I think again, if I am going back to explain you, we had 4 approaches. So far what we have done is we have discussed price setting short run, price setting long run. Now we are going to discuss price taking from short run perspective. Price taking from short run perspective. Price takers from firm pricing short-run product mix decision applies where opportunities exist for taking short-term business at market-determined selling prices. Applies where opportunity exists for taking a short-term business at a market-determined selling prices. So market-determined selling prices, you will decide. Cost information required and same condition apply as those specified for a price setter facing short-run pricing decisions. What is important is the relevant cost for you to make the decision. In short-term, capacity constraints apply. The product mix should be based on maximizing contribution per limit. If there is a capacity limit, so you produce whatever the item which maximize the contribution. I think you may discuss this part in a different perspective when you discuss the CVP analysis also. Limiting factor. Capacity, if the capacity means low contribution factor. Sufficient capacity is available for all resources that are required from undertaking business. Then the company will not commit itself to repeat longer term business that price to cover only the short run incremental price cost. If any product, if not covering the incremental cost, in economics, I think you studied the marginal cost or the variable cost. If the variable cost is not recovering, we are not going to produce. The order will utilize unused capacity for only for a short period, and capacity will be released for use of more profitable opportunities. If there is a capacity surplus, unused capacity, we can use that to maximize to increase the profit order to make more profit or profitable opportunities. In longer term, firm can adjust the supply of resources. In longer term, a firm can adjust. Now we are coming to the fourth one, price take a firm pays in long run product mix decision. A long-term firm can adjust the supply of resources. Therefore, the sales revenue from a product or service should be sufficient to cover all of the resources that are committed to it. So then you will think about resource committed to particular product, not the contribution approaches, resources committed to that particular product. That means directly attributable cost for a product, whether it is variable or fixed. Periodic profitable analysis is required to analyze, required to ensure the only problem. So thereby, under price take a firm pacing long run product mix, what we do is we use the profitability analysis techniques. So where the profitability analysis technique is used for product mix decision. Profitability analysis can be facilitated by, again, activity-based costing. I think you can remember activity-based costing, what we discussed. Now just look at the pricing long run product mix decision. So you see that there are three product line: product A, product B, product C. Product A means same marketing mix. Product B use another marketing mix. Product C use a different. That's why you get product line. A1, A2, A3, three products. B1, B2, B3, another product. C1, C2, 3, another product. But they are in line with the one line, one mechanism, one marketing approach, maybe one distribution, maybe one particular way of handling, promoting. You see that sales are given. So you get the sales of 600 from product, what do you call, from product A line, okay? And also from product B line, you get that much of sales, and product C, you get that much of sales. So thereby, you get the total of sales 600, 1,500, 2,400, which is 4,500. Then what you do is less direct attributable and fixed cost. You see, direct cost, variable. So thereby, what you do is once you deduct this, you get the contribution to the product line fixed cost. Here, remember, you are reducing the fixed cost even, which is applicable to the product. which is applicable to the product. So 80, 140, 104. So we call it contribution to the product line fixed cost. So you see here, one product B2 is not really recovering the cost or the resources committed to B2. Resources committed to B2 is 550. But the market price, which we are taking from the market, we are a price taker. You can't increase the price. You have to sell it at 500 rupees. So this is minus 50. So what you have to do is, you can't continue this profit. You are a loss making. B2 one is a, but altogether, if you look at the total profit for a business, so you are making a profit. That is not a problem. That is not a problem. But you need to, you need to do the profitability analysis. If you are a price taker, you can't sell this product. So thereby, now you have to take a decision whether to really give up that profit, whether to stop that profit or not. So when you decide, when you take this decision, cost information, maybe your discussion will start with the cost information. Why? We see that value of the cost and the sales revenue is, there's a negative figure. But you may decide, you may consider other factors, especially B1, B3. What happened to the sales of B1 and B3 if we stop B2? Whether the B2 is going with B1 and B3. What will happen to our image of the business when you drop the product B2? Whether the customers will assume that we are going to collapse, we are going to become bankrupt, we are going to stop the business. Will there be such a what do you call situation? So thereby many factors. What would be the government regulation, rules and regulations? What is the nature of the competition? So many factors. What will happen to the employees of this particular division, this particular product B? What will happen to the experts involved in the B2? Something like that. Your social responsibility. So many factors what we discuss on the internal and external should be considered before closing down the product B2. But looking at the price information, your product mix, product line B product mix has to be B1 and B3, not the B2. That is the product mix you plan. But before finalizing the decision, before dropping the particular B2 product, you need to consider more information. You have to discuss with your marketing team, with your production team, with your other accounting teams. So you have to have a very good discussions, excellent, fruitful discussions before stopping the product. But the cost information provides that taking price which is in the market 500 rupees is not really worth for us to continue the product B2. So then there may be fixed costs directly attributable to the product line. Now this particular 350 is applicable to the product line, not the individual product. Here you see this 300, this 500. So thereby now what you get is the total 400 from product A line, total profit from product B line, total profit from product C line will now match with the fixed cost directly attributable with this particular line, product line. So you will end up with the contribution to the business sustaining fixed cost. So product A is sustaining by contributing 50 rupees profit to the business. Product B line is contributing 90 rupees, and product line C is contributing to the business 300. Together profit is so much. So this is the business contribution. This is the each product line contribution, and you may have corporate headquarters fixed cost. The business facility sustaining fixed cost is 200. So thereby your business really end up with 320 profit, overall profit. This is called profitability analysis, meaning that you are making a product-wise cost information comparison. You are making a product-wise cost information comparison, but you will identify always, the variable cost, directly attributable cost, fixed cost attributable to your product, fixed cost attributable to your product line, fixed cost attributable to the business, total business organization, or fixed cost applicable to facilitate or providing facilities to the product line. So I think with that, it's clear. Now what we have done is we have covered up all the pricing method, 4 methods: price setter and the price taker. Price setter, 2 methods: short run and long run. Price taker, short run and long run. But it's price taker use the cost information not for pricing, but for setting up, but for arranging, but for planning their mix, product mix. Right. The reason for I think cost plus pricing is widely used. The reason is many encourage price stability. It won't wane. Price stability. There is a logic always for the price. There is a base for the pricing. Even though price may increase or decrease, there is a base for pricing. For example, if you can introduce a pricing formula for gas, pricing formula for petrol, the essential items, pricing formula for trivial public transport, pricing formula for highway transport, etc. I think stability is there. Then everybody knows the reasons, logic for price increase or decrease. Stability is meaning is not always fixed. Stability means there is a base, there is a logical reasons for pricing. There is a scientific way to decide. That's the meaning of price stability. Price stability meaning is not always price is fixed. Then it's simple, simplicity. Cost plus pricing is simple, very simple. You identify your variable cost, add a markup. You identify your total cost, direct material, direct labor, other direct cost, and the fixed overhead cost. Then you add a markup. So it's very simple. Difficulty in applying sophisticated procedures where a firm market hundreds of products or service. Even though you produce hundreds of products, very easy. Difficult in applying software where firm markets hundreds of product or service. So when there are many products, I think it's difficult. Yes, use a guidance to setting the price, but other factors are also taken into account. So you have to consider other factors when finalizing the price, as I told you. Limitation of cost plus pricing is ignores demand. Cost plus formula may suggest 20 rupees per product where the demand is 100 untils, whereas at price 25 demand might be 80 units, assuming that the variable cost for each unit is 15. The total contribution will be 500 at selling price of 20 compared to total contribution at selling 20. Thus, the cost plus pricing formula might lead to incorrect decision. So, for example, say 20 product where the demand is 100, then if you suggest to sell 20 product on the other, whereas 25, if your unit cost is 15 rupees, I think just take these two information. Here the selling price 20 and your variable cost is 15, thereby you will have a 5 rupees profit, right? So 5 rupees profit, you can sell 100 units at what do you call this this particular price. So thereby multiplied by 5, so you will end up with 500,000. profit of contribution of 500,000. Okay, but if your selling price is now say 25, if it is 25, then of course unit selling would be 80, right? And variable cost remains same again. Then the difference is 10 rupees. So thereby here what happened is you multiplied by 80,000 units by 10 rupees. So then your profit is not 500,000, then your profit is how much? 800,000 at the selling price. Thus the cost plus pricing formula might lead to incorrect decisions. Cost plus pricing may be, incorrect decisions. Since cost plus is ignoring demand. Cost plus pricing, according to cost plus pricing, whatever the price, whatever the unit demand, if you decide it 20 rupees, price has to be 20. Whether it is 100,000 unit, you are selling, or whether you are selling 8,000 units, whatever the units you are selling, cost plus pricing say 20 rupees or 25, whatever. So thereby it won't vary with the market demand, but one major weaknesses of the cost plus pricing is that you ignore the demand. You just focus on factory, inside your factory. You ignore the demand. Then the pricing flow, another story. Consider hypothetical situation where all the costs attributable to products are fixed in short run, an amount 1 million. Assume that the cost per unit is 100 derived from the estimated of selling with 10,000. Selling price is set at 130 using the cost plus method and markup 30%. If actual sales volume is 7,000 units, sales revenue will be 910 compared with the total sales of 1 million. Therefore, the product will incur loss of 90 even though its price above full cost. So pricing flow is that. Pricing flow is, now suppose as in the given here, a product are fixed in short term, and amount to 1 million. If the cost is 1 million, right? If the cost is 1 million, now you have to understand this. So you divide by the volume of expected volume, estimated sales, 10,000. So thereby what we are trying to say is that your cost would be 100. Your cost would be 100. Agree? If you add up markup of 30%, right? If you add up the markup of 30%, what happened? Your selling price would be 130. Agree? Your selling price would be 130. That is what it says here. Right? 130. So what happened if your actual sales is 700,000? If the actual sales is 700,000, right? Now what happened here is 7,000, sorry, not 700. Yeah, 700,000. If your sales is 7,000, not the 100, 7,000 multiplied by 130 would be your income, which is given in the question 910, which is 910. But your cost is not changing 1 million. You will end up with 90,000 loss. That is the problem. Why? When you sell more and more units, your unit cost fixed reduce, When you sell less amount of units, your unit fixed cost would be high. For that reason, we call it pricing flow. If you can keep the volume, estimated volume here is 10,000. If you can sell 10,000 or more than 10,000, you are good. If you are selling less than, your actual sales are less than 10,000, then you are not in a good position. So we call it price inflow. Price inflow. If you sell more than 10,000, then your position is much more better. That's called price inflow. When you sell lower amount than the estimate, that's bad. When you sell more than the estimate, that's good. So it's because of the behavior of the fixed cost. Circular reasoning. Circular reasoning means when unit fixed cost, volume estimates are required to estimate unit fixed cost and ultimately price. Circular reasoning means when your unit selling units changing, then what you have to do? You have to update, you have to change the price. That is called circular reasoning. Circular reason. Now, in this case, you calculate the price at 10,000 unit 130. Of course, if you calculate the price at 7,000 units, price would be more than this. That's called circular reasoning. So I think you understood. There are three reasons in cost plus pricing, three limitations. One is it ignores the demand. Other one is price inflow, and the last one is circular reason. Then we will discuss three policies: price skimming, where you are setting a high price just to maximize the short-term profitability, spending heavily on advertising and sales promotion to obtain sales. You may adopt this pricing strategy when you are entering into the market or once you establish. Penetration pricing means basically you are charging initially low price to obtain a sufficient penetration market share. Here you are going with a very good high brand, well-established brand, so with high prices, with quality. Here you are going low price just to capture the market. Here the objective is to get more market share. Pricing policies may vary depending on the different stage of the product life cycle. So product life, I think you can remember the product life cycle. So product life cycle would be, I think you can remember the stages, 4 stages. Introduction, growth, maturity, decline. Your sales would be something like this. Sales. Profit line would be something like this. Profit line would be something like this. So the pricing policy, whether it is price skimming or penetration, will depend on where you are. For example, for certain products, if you are in the introduction stage, you don't have develop a very good brand. Initially, what you may enter to the market with low prices, but you are introduction stage, but you are going with a strong brand, say McDonald's, Medias, Samsung, Apple. Your brand is, if you introduce an additional product, new product, you have a chance of introducing the product at not low price, but high price. Anyway, that is a matter of for you to discuss and read further. So shall we just go to the next one? 7.6. So I would like to see your answers. Take 5 minutes to read the case and just put your answer in summary form. We'll see what is your answer. Read the question and just give me the answer A, B, Z. Very short, not longer answers, very short answers. So I will explain the case, then you decide what the answer is. A producer of high quality executive motor cars has developed a new model, new model, like a high quality new model, that it knows to be very advanced both technically and in style by comparison with the competition in its market segment. So based on this line, can you decide this particular motor car style, the product, new model, or the particular company is a price taker or price setter, or the particular product is in the perfect market or not? So I think it's, according to this information, it's a new model, high quality executive motor car, knows to be very advanced both technically in style by comparison with the competition in its market segment, meaning that the product is unique. That is, with this introduction one, I feel that its product is unique. The company's reputation for high quality is well established and its servicing network in the major market is excellent. So you have a very good distribution channel also, and you have a very good brand image, maybe Mercedes, BMW. However, it is record in timely delivery has not been so good in previous years, although this has been improving considerably. So they had a weakness. What is the weaknesses? On-time delivery was not really practiced. So the delivery time was delayed, right? But it is improving. In the past few years, it has introduced annual variation improvements in its major models. They have done the variations, improvements in its major model. When it's launched a major new vehicle some 6 years ago, the recommended retail price was so low in relation to the excellent specification of the car that a tremendous demand built up quickly, and 2 years queue for a car developed within 6 months. You see now, the particular car, the business, they have done very changes, and 6 years ago, the recommended retail price was so low, but now I think they are in a very good position. They have a very high demand and very difficult to cater for them, and people are in the queue. Within 3 months, a second-hand model had been sold at auction for nearly 50% more than the list price, and even after a year production, sizable premium above list price being obtained. Even for this motor vehicle, second-hand market is very high. The company considered that in relation to the competition, the proposed new model will be attractive as was its predecessor 6 years ago. Control of cost is very good, so the accurate cost data for the new model are to hand. Accurate cost data may be activity-based costing, cost management. So their cost aspect, cost controlling aspect, cost management aspect is very strong. Management accounting practices with regard to the cost, strategic cost would be much more advanced. It's a plus point. For the previous model, the company assessed the long-term targeted annual production level and calculate its price on that basis. A company assessed the long-term targeted annual production level and calculated its price on that basis. In the first year, production was 30% of that total. 30% of that total means even though when you say 10,000 cars, but your production was 30% in that. The present model of the company expect the relationship between first year production and longer term annual production will also be 30%. So thereby, when you estimate 10,000 cars, but you can produce only 3,000. So thereby, you have to be careful about the pricing flow and the the pricing flow story and the circular reasoning when you adopt the cost plus method. Although the absolute level in both cases are expected to higher than the previous. The senior management committee of which you are a member has been asked to recommend the pricing approach that your company should adopt to the new model. A list of major pricing approaches available in this situation. Discuss in some detail the relative merits and disadvantage to the company of each approach in the context of the new model. What do you think? What are the approaches? Right, you can put that into the text box. To recommend which approach you would propose, given your reasons. Given your reasons. Outline briefly in which ways, if any, your answers A to B above would differ. If instead of a high quality executive car, were pricing a new family model of car with some unusual features that the company might introduce. Okay, one answer is price skimming policy. But here I like your answer, there's no problem. But to recommend to list major pricing approaches. Okay, you may say price skimming. Price skimming is where you really, as we said, where you enter into the high price. That is true. But how do you decide the price? How do you use the cost information? How do you use the cost information? For example, do you think that the particular company with regard this particular model facing the price setting environment or price taking environment? If price setting or taking, if you focus on, I don't think it's price, we will focus on short-term pricing. I think here we are focusing on long-term pricing. Okay, price setting. If price setting is applicable, what is your approach? Price setting means you use the cost information to decide the price, not for product mix. Yes. Any other answers? I think I explained you the case very briefly, and it's a unique product, and they have a very good brand, as someone explained here, and also they have a good costing system. And now they are asking for us to decide, how do you decide the price? Any other answers? I think you can, for this case, your answer would be the price setting situation, where when there is a price setting, what you do is you have different cost plus approaches. So your answer would be either direct cost plus, direct variable cost plus, or full cost. That is the pricing approaches what we focus here. For the first answer, for the A part, my answer is that what is the question? The list the major pricing approaches available. So we can write the particular business facing the price setting situation. So thereby you can go for cost plus pricing, either variable cost or the direct cost plus or the full cost plus pricing. To recommend which approach would you propose given your reasons? So one thing is since they are you see that their estimated cost, the full capacity and the actual capacity, there is a variation. So thereby better to use variable cost plus pricing. Then you ignore the fixed cost, you charge a certain amount of percentage for the fixed cost. But if you can use not the full capacity to decide the fixed unit cost, if you can use 30% capacity, say capacity per month is 10,000, out of that 30% is 3,000, you can calculate the unit fixed cost based on this 3,000. Then of course you are just addressing the pricing flow and the circular reasoning in a way. Anyhow, whether you decide the whatever the cost plus method, you need to be careful. So thereby I recommend direct variable or the variable cost plus method for this answer. Reason is that just to avoid the circular reasoning and the pricing flow issue. That is the reason, because it says that the full capacity and the 30% actual sales, and it will continue. That is their experience. Okay. The third one is high quality car with unusual features that company might introduce. So thereby you are going with, and also you see that even though in this context, you see that it seems that this particular model, they are trying to, even though they are in the 30% capacity, demand is very high. And for the second-hand market also, there is a very high price. So thereby you need to highlight, especially in your answer C, if you adopt the cost plus pricing, right, you have a problem. What is the problem? You ignore the demand. You ignore the demand. Since you ignore the demand, if you are recommending under part B, cost plus method, what you have to do is we can adjust the cost plus pricing so as to match with the demand. So as to match with the demands. That is one area. The other area is, as someone else mentioned, that since you are going with high quality, very good brand, so you can go with little bit high price than the cost plus price what you decide. Maybe cost plus price may be 10,000 euro, whatever. So you may end up with, even though the cost plus pricing is 10,000, you can say, okay, no, not the 10,000. We can sell it at maybe at 12,000 euro, right? What we ignore here is in the answer, major pricing approaches, we can say cost plus, direct variable, fixed cost. But in addition to that, someone can mention that another approach මම කියන්නේ part A එකට answer එකක්. තව approach එකක් ඇතුළේ target costing approach. Where cost plus pricing is focusing where cost plus pricing focusing the internal factory cost resources you consume. Target costing focuses the customer's expectation. So thereby, in a way, when you look at the target costing, you consider the demand, because you are starting from the price which the customer is ready to pay. So thereby, one answer for this, another approach for this, you can say target costing. So then what you have to do is, when you target costing, so you start from the target, then you decide the cost and the gap identified. Then of course internal what do you call cost reduction policy strategies has to be implemented, right? So if you propose the target costing method as the recommended approach, then you have to write those things also with the reasons. But if you propose the cost plus, you can write same way what I explained in the earlier. It depends on what you propose. I hope that you got the point. Okay, finally what we have is we have price reviews, sales units and value, previous year's comparison, different market channels and comparisons, budget versus actual comparison, forecast versus budget comparisons, forecast versus actual comparisons, present forecast product cost, production marketing, fixed variable, type of customers getting the most and largest price reduction, product unit and total contribution in different market, stocks of finished goods at different points of in distribution chain, customer attitudes to company price and packaging, market share individual markets, price complaint, from customers, from salesmen, number of lost customers, number of inquiries, sales below list price, competitors price condition for sales, inquiries, subsequent sales. I think even though I read these items without any order, of course you see 1, 2, 3, 4, 5, 6, 7, there are 13 lists, 13 matters. What we are trying to communicate by using this pricing review is, once you decide the price and declare, you need to have a accounting information system to get feedback. So thereby, when you get feedback on pricing, you may get your feedbacks information in relation to these 13 areas. For example, you may compare your sales in units and values with previous years. So this year sales, previous year sales. Or you may have different markets, then you can compare different market sales. For example, you may have physical sales and the online sales. So you can compare the online sales with last year sales with this year online sales. Last year physical sales, and physical means customers are coming and coming to showrooms and taking items. Online means e-commerce store. So you can have a different comparison and also in different market. For example, you may discuss the Western province sales, compare with the, you may compare last year Western province data, sales data with this year Western province data, or the regional, maybe Asian regions. Likewise, you can compare. It's a kind of feedback you are getting about your pricing. So you can identify whether there is a problem in pricing, whether there is an issue in sales. Because sales is a function of demand and the price. Sales revenue is a function of demand and revenue. price. So thereby you need to know whether there is a problem in pricing, whether your price is very low, high, problem. Then you can, of course, consider the same data, sales units and sales values with budget versus actual, forecast versus budget in comparison, forecast versus actual comparisons. Likewise, your sales can be compared with different benchmarks. Not only annual sales, you may compare your sales, daily sales, weekly sales, monthly sales, depending on your sensitivity or the nature of the competition or the leadership of the market. So thereby, what I'm trying to say is that one review would be comparing your sales units and sales values with different benchmark with different intervals. Second one is present and forecast product cost. So you have to forecast what are the present production and marketing cost, product cost, and what are the fixed and variable. So you may have a very good idea about the pricing. So fixed and variable cost classification and the price that you are selling. So you may have a very good idea. Now, for example, when you have a continuous costing data, you will realize that whether you need to update your price or not, whether your price reflect all the cost elements, whether you are a price taker and price setter, irrespective of the price setting and price taking a perspective, whatever the approach, whether price setting or taker, you need to do the pricing review. Types of customers getting the most and largest price reduction. Who are getting the reduction, discount? Are they unusual costs, usual customers, large purchase items? You need to look at who are getting price discount. Product unit and total contribution in different markets. Which market is performing well? Which market is performing badly? Stock of finished goods at different point of distribution chains. So this is just to identify slow moving items. Whether the items are moving or not, you can identify. If items are not moving, there's a problem. We don't know the problem. What is the problem? But maybe pricing issue, maybe quality issue, maybe marketing issue. We don't know, but you need to collect data about the stocks movements. Customers' attitudes, the company price and packaging. So what are their attitudes? What are their values? So thereby you may have a survey, questionnaire, complaint box. Once they purchase the item, you may ask customers to fill a form to get the really feedback. Or you may fix in certain showrooms. You see that they have fixed the camera. They observe, they select sample and they observe. Marketing people are observe. Once they enter into the showroom or the whatever the sales center, what is their facial expressions when they say take the products? Are they really looking at the product happily, the surprise, or they just express their negative attitudes toward the packaging, negative attitudes toward the pricing? So thereby such a camera system, such an information system, a team to monitor such information system is vital in certain cases, not for all cases. Then the market share of individual markets, you can compare the market share. Market share has increased or decreased. You know market share, your sales divided by the market industry sales multiplied by 100, you get the market share. Price complaints from customers, whether it's formal or informal, that's informal. Price complaint getting from salesperson, where sales representative. Number of lost customers, you may have a record, you may have to get. Number of inquiries, very good. So you may keep a record about number of inquiries and you may compare the number of inquiries with number of sales invoices. If your number of inquiries is 10,000, but sales invoices are 100. So you see that 900 or say 1,000 inquiries, 100 sales. So you say 900 inquiries, no sales, just inquire and vanish. whether the nature of the business, nature of the industry, or is it a problem of ours? Is it a problem of price? Is it a problem of, the, reception? Is it the problem of marketing officer who is in the showroom? Is it a problem of a system? If you are selling using internet, so is it a problem of internet-based system? Number of inquiries, sales at below list price. Which occasions you have done the sales below the list price because it's violation of internal control. With the permission of top management or the high level management, you may sell certain product at a lower than the listed price, but it has to be very, very rare or zero. Then competitors' price and condition for sales. You have to always worry about what the conditions, what the competitors' price and their conditions for sales, and inquiries and subsequent sales. So that those are the pricing mechanism, pricing review, which you have to really undertake when you do this particular story. So I think with that, the session is over. If you have any question, what I can do is I can answer. Otherwise, we will wind up the session. Okay, then we will wind up the session. Thank you very much for joining. There are only 7 students. What to do? I don't know the reasons. Okay, bye.